Michael, you're back, which is awesome. Thank you for joining us today. It's been a little while since we were last sitting here with you, and there's been quite a few developments in the space that we're interested in. So we thought it would be great to have you back and have a chat about the finance landscape for co-living properties. Just on a personal level, I understand that since we last spoke to you, you were again nominated for Broker of the Year. Is that right?
Yes, that is correct. So
Congratulations.
Thank you. It's third year in a row.
Third year in a row, very exciting. So I feel very privileged to be sitting across the table from you. And I think our listeners should be very happy to be able to get access to your brain on those pretty specific topics that we want to talk about. So just as for people listening, as just a broad sort of description of the landscape, co-living properties are fantastic in a completely unbiased sort of opinion. But no, more seriously, it's a great opportunity. It's also quite specialized. So a lot of lenders haven't fully wrapped their heads around it, or they find that to be too small a niche to be concerned about it. Anyway, there's a number of reasons why this has really fallen into really specialized lending. It's sort of kind of residential properties as far as the asset is concerned, but the income is more like a commercial property. It falls somewhere in between a few different circles, so that it's quite complex. And dealing with co-living investors now for quite some time, I've seen all sorts of fixes or half fixes that clients are using to try to optimize their finance outcome as far as co-living properties are concerned. It's not always ideal. So I wanted to sort of bring you back here so we can have a chat, see where things are at, how you're dealing with things, and sort of how things are working. But just to get us underway, I just thought I'd start with something pretty generic and not so co-living focused, and we'll get into that pretty quickly. But it's a topic that relates to anybody investing in property, and it is sometimes misunderstood. So I thought maybe I can use having you here just to shed some light onto it. So do you want to maybe take me through what is usable equity?
Yeah.
Right. Just so people understand exactly how they can assess themselves and understand where they're at.
Yeah. I mean, typically available equity is your property value and up to 80% of that, which normally a bank will lend to. And therefore, if you owe, say, $500,000 on $1 million property, your available equity would be that $300,000 difference up to that $800,000
so
loan size.
Yeah.
And therefore 80% of your property value. The constraints are, though, is that even if it's available, you still need to be able to service the debt. So your income does play into it, which is also important in being able to retrieve that equity out to use towards whatever the purpose of those funds would be.
Right. So clients come to see you with the idea that they're going to buy another property. One of the first items you would look at is the available equity. As you said, if their existing property is worth $1 million, you go, okay, we can get up to $800,000 in principal against that property. So $800,000 minus the existing debt, whatever that might be,
yes,
will give them the usable equity on the premise that there's enough income
to service such debt.
To convince the bank to lend them that money.
Correct.
And then that available equity then can become the deposit or part of the deposit toward their next sort of purchase.
Yeah, it can actually be the deposit and costs and everything associated with the entire purchase. Stamp duty, lender's fees, etc.
Yeah, it could even maybe touch on, could help with the holding cost while the property is being built.
As well. We can take buffers out to make sure that you can get through the construction, if it was a construction, to ensure that, there's no rental coming in. So there will be still smaller repayments throughout that time as the construction loan continues. We can take out a suitable buffer to allow for that.
And just again, assuming I don't know much, you typically, would you use sort of one lender to sort of release that equity and then do the construction, or can you sort of do one in one place because it might be cheaper or whatever the case is, and then do the construction somewhere else or the purchase somewhere else? So how does that work? Is it all in one, or do you keep things separate? Or
it really depends on the client situation. So, some clients are still fixed. So, might take that portion out from the bank that they're still fixed with. There might be some servicing constraints where we will have to take it to the lender, where there's also the investment that they're looking to buy as well. So we can use all of that rental income in serviceability. It does depend client from client, but basically we can do both.
Yeah,
depending on the situation.
That's very flexible. That's good. But you don't have to. Yeah, it's okay. Yeah,
100%.
No, understood. So that makes good sense. And I think for the benefit of people listening, just from our side, from Harmony's sort of experience, because the strategies that we put together are such high yielding strategies, servicing, which is generally one of the two constraints that you have in building your portfolio, is not much of an issue, because the properties that we tend to get people into will generate quite a lot of income. So the banks are quite easily satisfied that, that property is going to pay for itself. So granted that you're not in a tremendous amount of debt or sort of financial difficulties yourself to start with, then the property tends to do all the heavy lifting on the servicing side. So the available equity is a key ingredient of the dish that we're trying to cook. Granted that people have access to that available equity, which can be topped up with savings or other things, but if we can get that sort of deposit together, then the servicing typically works really quite straightforwardly by virtue of how much income those properties are generated. So this available equity concept is crucial in order to ascertain if someone is going to be a suitable prospect for one of those high-yielding properties or not.
Definitely.
Which is great. Thank you, Michael. And that's a really nice sort of segue into the next question I wanted to ask you. Being specialized and, coming with sort of the challenges that we touched on before, I know I can go and purchase the property across the road from mine, and typically I would be able to borrow 90% of the value of that property. So I'd have to come up with a 10% deposit and then, cover the stamp duty and the other costs. When it comes to co-living, what are our parameters here? Like what are we working with in terms of how much money do I need to come up with? How much is my available equity and sort of cash needs to come to in order to have a reasonable prospect to actually be able to buy one of those co-living properties?
Yeah, look, at the moment, we would say, and it depends on the structure as well, because different structures have different lenders and different lenders have different deposit requirements.
Yeah.
But if we were talking on the general point of view, normally around a 30% deposit plus costs will cover a purchase of a co-living property, where we can basically lend up to around 70% of that value. In different structures, we can go up to 80% with some lenders.
Do you want to take me through just structure being...
whether it's in your personal name, in a trust name, or in a self-managed super fund. Right. They're all sort of different ways that I guess we can finance it from that point of view, depending on what the client would like to purchase in.
Perfect.
In saying that, in the personal side and trust side at the moment, general trust side, we can lend up to 70% of the construction, land and build value.
Mm-hmm.
And inside super, where we can only lend to established properties that are built. With some lenders, we can go from 70 to up to 80%.
Right. Okay. So actually from a loan to value ratio, surprisingly the self-managed super fund.
Yeah. And in this case, which is unusual.
No, that's good.
In this case, we can go higher, which is fantastic.
That's exciting.
And then, leading with different lenders, the other thing that can change how we can lend to it is the valuation and the way they interpret that rental yield as well.
Yeah. Perfect. So you're talking lenders. Again, I'm going from sort of what I'm experiencing as an investor myself and what I'm seeing some of our clients going through. If I'm going back to that property across the road from me, if I'm buying that, I'll probably have, 40 lenders that will lend me money one way or another to purchase that property. The pool of potential lenders is much smaller for co-living properties. Is that a fair statement?
Definitely. At the moment, it's really important that you get the right lender to lend to it properly, so you can make the most of those deposit requirements, the servicing requirements, etc. We are limited to only a very limited few lenders at the moment that will do those important things that we need, such as the valuation and interpreting and using that rental income towards serviceability. We're a generic lender for the property across the road. We'll just take into account the standard rent and etc. straight away.
Yeah. So valuation seems to be a big one.
Definitely.
Do you want to maybe explain to us what the difference between a valuation or typical valuation, for lack of a better description, versus a co-living valuation? Like, what's the...
Really, the main difference is the way the valuer values the property. They go on a semi-residential / commercial style valuation where the income is interpreted in the value of the property. Obviously, these properties are high yielding compared to a standard property, and therefore the valuation needs to take that into account to justify its value. Obviously, it's more expensive to build given it's specialized,
of course.
And therefore a specialized valuation is required, and therefore a specialized lender is required as well.
Yeah, that sounds a lot more like a commercial valuation from what I've seen in my days. Right. Again, when I've done commercial deals, sort of non-co-living, but commercial deals in my times, those valuation usually were sort of slower and more expensive. Is that something people should be ready for, or what are you seeing?
Definitely. Like a standard val on a standard residential property can take anywhere between 3 to 5 days to come back, and it's normally a few $100s. A commercial specialized valuation of sorts can take anywhere between 10 to 30 business days, and can cost anywhere from in the few thousands to 5,000 or so, depending on the type of property it is, where it is, etc. All plays into account. We actually get those quoted for clients beforehand and then let them pick depending on what the quotes are available.
Right.
So then they can make a decision which one suits them best.
Terrific. That makes good sense. So that would also affect the overall time frame of your typical co-living application. I imagine if the valuation takes 20 business days, being one part of the process, how long does it take, and are there any things that people can do to optimize the time frame and make them stronger and more assertive when they go and purchase, so that potentially they can secure better deals?
Yeah, definitely. Like, we encourage all clients to get pre-approved first, which we can do. It's valid for a 90-day period. Normally pre-approval can take anywhere between 10 to 15 business days to set up.
Yeah.
Once set up, we've got 90-day window to go and get the property. And given how long the valuation takes, having that pre-approval in hand, ready to go when or before signing a property, will basically get you purchase ready to attack.
So that will essentially save you sort of that 15 business days altogether. Then
straight away.
You're pretty much down to that valuation.
100%.
Yeah, okay. And that gives you enough certainty to go hard when you're purchasing. That's great.
Definitely. And we can also tie that in, like if clients have that available equity that we were discussing and they want to get that cash out ready to go, so they have the deposit.
Yes.
Like, we need to get them purchase ready so you can go out there with confidence to buy the property straight away and not be too concerned about the finance.
Yeah, that's like training for your high rocks before you turn up. You're likely to get a better outcome. 100%. Yeah, I understand that. Right. Now, when lenders are looking at those more specialized securities, and I think you've touched on that with the valuation sort of reflecting the rental income, and that's a really key points for us, because what we sort of conveying to clients is how high yielding properties open the door to building a much broader, much bigger portfolio of property, which then has an incredible exponential impact on their financial results after 20 years. So, you can have 2 properties doing extremely well, or you can have 10 properties doing okay. The person who has 10 properties doing okay is going to do way, way, way more money than the person who's got 2 properties doing exceptionally well.
Yeah.
And then there's obviously the option, and that's what we're trying to achieve, to get 10 properties that do exceptionally well. But the size of the portfolio is very crucial, because the growth applies to the overall value of the portfolio. and it compounds over the years. One of the reasons a lot of people fail in their endeavors to get that sort of financial freedom is because they get stuck at sort of one property or two properties, whatever the case is, based on their incomes. But if each property is going to sort of strengthen your ability to purchase and to borrow more moving forward, then you're going to be really just only limited by that available equity that we mentioned before.
Correct.
So I know real world, say property A is going to generate $150,000 a year of income, which would be, not unusual for a 9-bedroom co-living property. It might make $150,000 of rental income. How's your lender looking at this? How's your valuer looking at this? So, we've got 9 bedrooms. Each of them is going to rent for $400 or $500 or whatever the case may be. That house is typically going to make $3,000 a week, $156,000 a year. What does that look like once you put your lender's sort of goggles on and you look at this? What do they see? What do they count? What do they use?
Well, I mean, really, the positive income will actually help your borrowing power moving forward. Like, all lenders are concerned about is income. The more income you have, the more you can borrow, the more you can keep going again. Normally, we're seeing properties go up in value, so your available equity is always building, but your income is what's important to keep that leverage to keep going. So when the property is so positively geared, we can use that income to basically help you get more debt in order to keep expanding. We've also seen when properties are built and rented, especially in the high yielding ones, that we've seen an uplift in valuations as well, due to the fact that now they're rented, the income's flowing in. The valuers actually interpret those as real income coming in now, and therefore they're valued at a higher valuation, which then generates available equity to then go again.
It's a beautiful cycle, and we've seen those valuation uptick in real life when clients sort of on-sell the property that they've completed. They achieve the same in terms of it. That increased valuation actually materializes in real life, so that's really powerful.
Yeah, definitely.
Now, when we're looking at sort of the entities or the vehicles that you sort of mentioned earlier, you've touched on the loan-to-value ratio that will change from this vehicle to this vehicle potentially. Is the vehicle going to impact the lending in any other way aside from the loan to value ratio, or is that pretty much sort of the biggest sort of impact that the vehicle will have?
Like, depending on which vehicle that you're using, if it's just a general trust or if it's your personal name or if it's a self-managed super fund, will all be interpreted, I guess, differently from a lending point of view. With the self-managed super fund side, on a general level, how it's interpreted is based on your super contributions and the rent and the deposit that you can bring to the table, and essentially that's what determines your capacity. And unfortunately, we can't get equity out of those properties once they're purchased inside super. But in your personal capacity or in a trust capacity, that equity that's available or the way it's structured for the first purchase as such doesn't make a difference from a lending point of view. Whereas in a trust or in your personal name, we interpret it the same sort of way. Moving forward onto the next property though, some lenders, if it's in a trust and it's so positively geared, some lenders can actually ignore that debt and ignore the rental, allowing you to rinse and repeat your original purchase. But sometimes we need that income to help your servicing, or we need that equity, and therefore we can use it from both points of view.
But it's really specific to your clients.
Definitely.
What about costs? Is my rate going to change if I'm using one structure or the next, or my name, or like, is there cost impact based on the structure that I'm using?
No. Oh, well, if inside super, yes. Super is sort of sits completely separate from that point of view. There is a few more entry costs and things to get in. But from your personal side and a trust side, there is no difference in rates or fees. All lenders interpret it the same way now, given how common trusts are being used. There used to be a premium, but there is no premium anymore.
Okay, fantastic. Maybe just to sort of wrap up the update, having your finger on the pulse and sort of organizing those loans sort of day in, day out, Are there any major sort of challenges or hurdle that you and your clients are facing right at the minute in this environment? Or like, is there anything to look out for or prepare clients to go, hey, we're going to get there, but
timing, definitely, like the way, how long things can take. So it is quite a long time period. That's why we try to get clients purchase ready.
Yep.
Going to the right lenders are very important. Going to your general bank to try and do one of these, normally you won't have the same success as going to a specialized lender who will interpret the correct valuation on a commercial style basis, as well as allow us to use the proposed rental income from that property in the serviceability to help your serviceability to start off with. So little things like that really make a big difference. Going to the right bank, getting purchase ready, given how long it can take to set it all up and have it all ready. So timing, definitely. And basically then finding the right property is the next step.
Yeah, conveniently, this is something we can help you with. But no, that makes perfect sense. Well, that's a really good sort of update. I'm racking my head right now. Michael, just maybe as a final point, and I know it's not everything, and I don't want to simplify this conversation to the extreme, but I think a lot of people are always interested in that metric. If you had to give us sort of a benchmark interest rate for co-living loans as of today, being what are we today? The 5th of December? Yeah. So 5th of December 2025, what would be a good sort of benchmark rate for people to use if they were looking at a co-living sort of property?
Yeah, look, at the moment, we're seeing the rate given on a sort of commercial style rate. It is slightly more expensive than your general investment residential house. So we're looking around the mid 7s, where we're sitting at the moment. I think as appetite grows, maybe that may come down, but at the moment, that's where we're sitting.
Yeah,
and that's inside and outside of super, which is great as well.
That's fantastic. And that makes perfect sense. We're still looking at properties yielding substantially above that particular rate. So,
it's still very positive.
Yeah, that's right. Yeah,
it's
still going to be, I mean, at that rate, it's going to be very cash flow positive. That's great. Michael, thank you for joining us again. And I'm sure until next time. Thank you
for having me.
All right. Cheers.